Good morning, everybody. My name is Markus Wilhelm. I'm the CEO of Stata Solar, and I'm here to make a couple of introductions. Before I do that, though, I want to thank again the people who organized the conference, because when we started conceptualizing this whole event 3 years ago, nobody would have expected that we are by 700 active participants at this point in time 3 years later. The goal was actually to have more than 500, more than the water conference, and we beat them, I think, already last year. So it felt pretty good. Greg Ganji and Cowell were really the originators of this whole conference from the business school and the Institute of the Environment. But in the meantime, other people have also stepped up and have made tremendous contributions in putting this conference together. I want to thank Steve Wall, Kathleen Glabby, Emily Williams, and probably many others. Tracy, I forgot to mention Tracy, right, who has done a really terrific job in pulling this all together. I mean, we are all happy from the organizational committee viewpoint. This has been a real success, and I think last night's keynote is a strong indication of how far we came since we started this about 3 years ago. This morning, obviously the students are not here. We have 260 students that registered. Who's a student in this room? Can you raise your hand? Wow, that's actually pretty good. You guys got up early, right? So totally unexpected, but very much appreciated. My job is to introduce this morning the Honorable Janet Cowell. And before I talk a little bit about Janet, I want to remind some of you who have been here yesterday morning about what Jay Faison and David Fountain stated, that energy and clean tech generation all needs financing, startup capital, investments. Any solar entrepreneur can actually tell you you're not really in the solar business, you're in the financing business. Without funds and without capital infusion, right, most of these large utility scale projects will never happen. So when I started Stata Solar a few years ago, around 5-6 years ago, I went to see Janet Cowell and asked her to invest into some of our funds, which she graciously declined. But if she had, her fund would not be down from 90 billion to 87, right? It would probably be up, but this is life, right? I mean, I can't really blame her at this point in time. We're a very small company. So Janet is a North Carolina elected treasurer and the first woman to hold this office. She has over 20 years' experience in the private and public sector in financial leadership positions. She oversees more than, at this point in time, 87 billion in pension investments for more than 900,000 teachers, firefighters, and public employees in North Carolina. As treasurer, she manages the 32nd largest public pension fund in the world. While many public funds are struggling to meet financial obligations, North Carolina's pension system is ranked second in the nation. Under Janet's executive leadership, North Carolina is one of only 9 states in the country that earned a AAA rating by all 3 rating agencies, which is kind of the good housekeeping seal of approval. Janet is a member of the State Board of Education and a champion for improvements in education, including financial education. Because of her efforts, North Carolina's kindergarten through 12th grade students began receiving financial education as part of their curriculum in 2012. The same year, Janet stepped up to oversee the state health plan, ensuring access to affordable health care for more than 680,000 North Carolinian families. Janet is a graduate from Wharton School of Business. She's the chair of the State Banking Commission and was recently chosen as an Aspen Institute Fellow. She continues the conservative debt management practices and solid economic development policies that kept North Carolina in secure financial standing, which is, I think, all you can ask for. I want to thank her for her tremendous service to North Carolina and appreciate her being with us today. Janet?
Appreciate Markus's introduction, and of course we'll have to invest more in solar. so we can get back over that 90 billion. We do invest in solar, so that's the good news. I am Janet Cowell, your state treasurer. And when you talk about state treasurers, it's always about the money. Some people, I used to go on a school board, and my seatmate called me money bags. Here's money bags. But it's ironic that I'm managing all that money, because growing up, my father was a Methodist minister. My mother was a public school teacher, and between the two of them, that's not, rolling in dough. And I remember as a child sitting in the wooden church pews watching Dad preach, and the brass offering plate would come by and Mom would put the check in, and I sort of thought, well, they're spending more time giving their money away than they are earning it or investing it. And then today I manage that $87 billion plus other monies for the state, so over $100 billion managed for the state of North Carolina. And the treasurer is a bit like the foundation of your house. You don't think about it until there's a big problem. I do things like investing, making sure we have a balanced budget, protecting that bond rating. So all the things that may not be that visible. The one part of the job that is fun, and if there's one thing you take away today, it's this unclaimed property program. Every year, or every month, there's an unclaimed property, right? Every state has one of these. If you lose money, it reverts to the state, and you can go to us, nccash.com, and find your property. And so I'll give you an example. I was in Wilmington last year, and I get to carry these big fake checks, my Ed McMahon moment, go ring the doorbell and tell people, I've got money for you. And this particular house was just a red brick ranch, white columns, black shutters, your classic 1970s ranch. Down in Wilmington on the coast, and the woman who answered the door answered it. She had this T-shirt on that said, "Grandma's my name, spoiling's my game." And I was able to get her story. Her husband had passed away about 10 years ago. She thought she had found all the life insurance policies, but lo and behold, she had missed one of the life insurance policies. And so I was able to present her with $10,000 that day, and I asked her, what are you going to do with the money? And she pointed up at the roof of the porch we were on and said, well, you can see, how I've got some rot up there. I'm going to redo the porch and the roof before the next hurricane season, and of course, I'm going to spend money on the grandchildren. So that's a good day in the treasurer's office. I'm here to tell you, I think, two pieces of good news around investments and clean tech and green energy. And that is, there's hundreds of pensions across the country. And as Markus mentioned, we're one of the larger. We're ninth largest in the United States. So there's a lot of money here in North Carolina. And pensions are thinking more and more about environmental, social, and governance, ESG factors in investment. In fact, we've been doing a survey, so about 25% of U.S. pensions now have some sort of policy around how they're thinking about investing across environmental, social, and governance issues. Another 25% are developing those policies, and then 50% are still pretty much not playing in the space. North Carolina is one of the ones that's really developing the policy. We are working so that hopefully by third quarter this year, we will have a formal framework for how we think about environmental, social, and governance factors. And that does not mean we haven't done this in the past. Well, we have invested in solar, we've invested in clean energy, we've done timber, we've done in-state investment programs. So we've been active, but we just haven't had a cohesive, coherent approach across the entire portfolio on what our policies were going to be and how this all gets knit together. So hopefully as we get more towards the fourth quarter, that with that entire $87 billion, there will be that more cohesive framework, and we may be out looking for more products that sort of meet some of the goals that we have. As part of the investment program, though, just to let you know of a few programs, we do have an in-state program that focuses on high-growth companies here in North Carolina. And we launched in 2010. We're at a university today, and we actually, Erskine Bowles, who was president of the university system at that time, stood with me over in the Golden Belt in Durham, the symbol of an old textile mill that's been revamped into more of the high-tech new economy. to talk about how we were going to invest a portion of the pension in high-growth companies here in state. We have done that. That was 2010. That fund, we invested $230 million across 28 different companies and different funds here. It's got a 21% IRR, so positive results so far. Of course, we still have years to go before we fully exited and realized all of the returns on that fund. But what we found is we were able to invest from sort of mountains to coast. And we invested across all industries, including high tech, a lot of technology companies, advanced manufacturing, life sciences, so a host. I will say that some of the tax credit deals in solar were harder to get just deals going on, to find the right partners. We do have those investments in our main portfolio, but in that in state, they were less of a presence than I was expecting in the portfolio. Because of the success of that, we launched a second innovation fund. And this all, by the way, if you were interested, if you have a high-growth company, you're looking for financing, and again, this is across all spectrums, from early stage to buyout. Tracy Harris is the local representative. She is with Grosvenor, so this is managed by an outside private equity firm, and she is based here in the Triangle. Some of you may know her. So Tracy Harris and my office, please reach out if you have thoughts. So we launched the second fund, having the first one be successful, $250 million, and it will have a very similar, you just have to have some sort of nexus with North Carolina, across industries, across stages, and about 20% is going to be early stage. So the second piece of good news is that there is, I think, more money available, not just that innovation fund, but one of the critiques I heard for years was, well, that's still not enough in the early stage. You know, that financing in the early stages had dried up, and that's where a lot of, in clean tech companies are early stage. They don't have long track records. And I heard that, but we have limited risk appetite in the pension. Obviously, this is about investing for the firefighters and teachers of the state, and I have to keep that first and foremost in mind. That said, if there's collateral benefits, so that's how we justified some of the in-state investment. But we're now using, I'm working with the governor to use that unclaimed property fund, the one that I mentioned earlier with the checks that we delivered to the woman in Wilmington. That's $450 million. And so we worked with the legislature and the governor to say we can invest up to 10% of that in early stage companies here in North Carolina. And we put that out to bid. We received a number of different bids, and we're assessing those. But hopefully, by third quarter, we should be ready to go and starting to make investments. So that will be an even earlier stage, more focused on pure venture, $40 million. And we're always looking to leverage and invest alongside other private players, so that leverages additional capital in the state. So that's and outside of that, I think you've also seen more activity with UNC looking at their cash management and freeing up $10 million for capital investment, as well as Duke, who's looked at funds to invest in spinoffs out of their alumni base and university R&D. So I think that you're seeing both a greater interest and framework around environmental, sustainable, and governance investing, as well as more pots of money coming available in the space. So I will leave you with those two pieces of good news this morning. And please, I'm easy to find, nctreasurer.com and that nccash.com, two websites you need to remember. But if you do have companies that are in need of financing or want to learn more about these programs, don't hesitate to get in touch. And I hope you have a great day here advancing clean tech in North Carolina. Thank you.
Thank you very much. It's my pleasure now to introduce our keynote speaker, Jim Hughes, the CEO of First Solar, which I always call the gold standard against which all other solar companies are measured. First Solar, for those of you who don't know the company or just know it by name, is the dominant leader in the clean energy market. There's nobody else, period, like that company. They are a panel and racking manufacturer, but mostly panel. They are a large project developer, and they are a super successful integrator and EPC company. For those of you who have not bought the First Solar stock a year ago and had a 40% gain versus the rest of their peers that went down 20% and the market went down 10%, right? You missed something, right? The company was in January actually worth more than the next 5 or 6 of their main competitors combined, right, in market capitalization. That gives you a rough idea of how strong First Solar is as a company. And no surprise, their shareholders obviously love the company, and they really like Jim Hughes and what he did with the company. When the solar stock market crashed a couple of weeks ago, and it was really some rough weeks, and a lot of companies took 10 and 20% hits a day, and certain companies like Sun Edison went down from, I think the last summer they were around $33, they're now $1.40 or $1.50, right? Or even Elon Musk's Solar City, very hyped residential solar integrator, dropped from $65 in January to $15 or $18 6 weeks later. First Solar was like a rock. Basically nothing happened. Maybe $2 billion or close to $2 billion in cash had something to do with it, or their leadership in technology, in panel technology, which is second to none in the industry. If you look at some of First Solar's 2015 highlights, they include record cell efficiency of 21.5% that basically nobody else can match, definitely not in the thin film arena. Record modular efficiency of 18.6%. Then they had record bookings of 3.5 or 3.1 gigawatts and over 1 billion in projects on the balance sheet. Goldman Sachs wrote, First Solar has the strongest balance sheet in the global sector. JP Morgan called them their top pick. So again, no surprise, investors like this company. Now, I consider them the benchmark for my company and any other solar company in the world today, because nobody has quite the same position, nobody has the same technology and technology roadmap. And this is why Stata ordered 1 gigawatt of panels, which are around 10 million solar panels from First Solar today. I also try to steal as many of his executives as possible, but we want to keep that between us, right? But First Solar was not always the powerhouse it is today. Their success has a lot to do with the leadership and vision of their CEO. Jim created a technology roadmap, which means it's a vision for where technology should be in 2, 3, 5 years from now, that led into an unprecedented panel technology advantage that is nobody globally can match at this point in time. He also had the company take a real leadership position, not just a lead, in project development and international expansion with total focus on the utility scale market. A lot of solar companies fumble around. They try a little residential, a little C&I, a little bit utility scale. I think good companies stay very focused to their strengths, and I think that's one of the key components of success that First Solar has today. So Jim has an extensive background in both the conventional and renewable energy sector, including executive leadership positions with AEI Services, Prisma Energy International, and Enron. Many people that know Jim, and one of them is my former COO, who I stole from First Solar, Mike Belikoff, called Jim once the probably most knowledgeable man in the global energy business. Once you get to know Jim, you will probably agree with Mike Belikoff. Jim is also a non-executive director of APR Energy PLC, a London Stock Exchange-listed energy company, participating in the global market for gas and diesel-fired temporary power plants. Most renewable guys like me, and many of my colleagues here, we know solar, we might know wind, but when it comes to oil, gas, utility-related issues, we are getting a little bit soft. Jim grew up in both worlds and really understands all aspects of energy, including the oil and gas business. Jim Hughes is also chairman of the board of directors of the Los Angeles branch of the Federal Reserve Bank of San Francisco. I want to thank Jim for being a good business partner and friend and for traveling across the country to be with us this morning. Jim?
Thank you, Markus. I agreed to speak on the condition that he not hire any more of my executives. So remember that agreement. I'd like to start today by relating a conversation that took place in 1931. This conversation took place between three good friends, Thomas Edison, Harvey Firestone, and Henry Ford. And they were talking about the propensity of the human race to consume the natural resources that were available to them and the need to transition at some point in our history to something more sustainable. They were debating the viability long-term of solar power, wind power, and tidal power, and each was advocating on one. But reportedly, the best argument and the winner of the conversation was Thomas Edison, who said, "I'd put my money on the sun and solar energy. What a source of power. I hope we don't have to wait until oil and coal run out before we tackle that." Unfortunately for Mr. Edison, he didn't live to see that day, as he passed away just several months after this conversation took place. However, for everyone here today, we don't have to wait until oil and coal run out, which isn't happening anytime soon based on current market activity. We are tackling solar today. Let me bring us to some recent quotes from notable members of the energy industry. Jim Robo, the CEO of NextEra, large southeastern United States utility holding company, one of the largest power generators in the country, one of the largest renewable energy developers, said very recently, post-2020, there may never be another peaker built in the United States. Very likely you'll just be building energy storage instead. Think about that comment. Second, Ben Van Beurden, the CEO of Shell, recently said he had no hesitation to predict that in years to come, solar will be the dominant backbone of our energy system, certainly of the electricity system. Think about these statements. Very, very remarkable given the people making the statements. I've been involved in the electric power industry for 25 years. For as long as I can remember, there have always been various future scenarios that put forth for the electric grid. There was always this future point, never precisely defined or identified, where solar power reached a cost point and massive adoption began to occur. IHS CERA used to refer to this point in their scenarios as the tipping point. Other consultants, IEA and others, they all had a way that they defined it, but it was always this some future undefined point. Various other terms have been used, grid parity being the most notable. I've always hated the term grid parity because it tries to simplify the notion of the grid to a single monomic power price, and hopefully everybody here understands that the energy system is dramatically more complex than that. But whatever you call it, or however you want to identify that used to be mythic point, we're there today. And how do I know that? Demand elasticity. So for the first time in the history of renewable power, certainly in the history of solar power, we are seeing visible demand elasticity in the market. We have reached a point with the cost of PV solar power that every time we achieve a further cost reduction, we trigger new incremental demand that didn't otherwise exist. And more importantly, most of this demand is fundamental in nature, not policy in nature. And what do I mean by that? By fundamental in nature, I mean the customer is making the decision on the basis of the fundamental economics of the choice, not as a result of some sort of policy mandate that they're trying to comply with. Given that the cost trajectory of PV is going to continue downward for years to come, Markus spoke of our cost roadmap. I'd like to say that we're the only people in the industry with a cost roadmap, but we're not. There are other very good companies with good technologies that have cost roadmaps, and they span not only solar but other renewable technologies. Cost will continue to come down as we move forward. There will be some asymptote. The rate of change may not be the same, but it will. So what this says is that you get this virtuous cycle of demand elasticity. As costs come down, you trigger demand. As you trigger demand, the industry scales. As the industry scales, costs come down, and so on. The best and most dramatic evidence of this is actually here in the southeastern United States. If you go back to 2012, and I remember this vividly because I came on board at First Solar in early 2012, the southeastern United States was not even on the radar map. If you were going to present a key markets or key customer analysis for the company, it would have centered on the Western United States. It would have centered on Europe. It would have centered on India and the Middle East. It would not have included the Southeastern United States. Then in 2013, the city of Austin put out an RFP, a significant RFP for solar power. There were numerous respondents and bidders to this RFP, including First Solar. We were one of the bidders. We lost. We lost badly, as a matter of fact. But that pricing came in at around 5 cents a kilowatt hour. It was an astonishing number to most participants in the U.S. utility industry. They had no idea that you could procure long-term solar power at those kinds of prices. What had happened, or one of the reasons it was so shocking, is the benchmark for solar power pricing was the WEC RFPs, the California RFPs. What no one had connected the dots, and I can't believe none of us did this and talked about it, when you came to a low-cost jurisdiction like Texas, where the cost of development and construction is dramatically lower than in California, which is a high-cost jurisdiction, and combined that with the roadmap that everybody had been traversing in terms of cost, and a lowering of cost in the capital markets. It was a magic mix of factors that generated this very unheard of, at that time, unheard of price for solar. The result was not only did Austin get a very good price for their electricity, but everybody in the southeastern United States immediately recognized that their D&I was very similar. A lot of those same characteristics existed, and essentially massive adoption began. And so today, if First Solar gives any presentation to analysts, or we just made a presentation to our board of directors, we now speak in equal terms about the Western United States. ERCOT, which is the Texas market, and southeastern United States, is basically being equal opportunity sets. And in fact, some of our largest customers, including Strata Solar, are based in the southeastern United States. This is all as a result. There's been no dramatic individual single mandate, policy mandate that's created this. There are some overlying policy themes that are still out there, the Clean Power Plan and others, but essentially what's happened is everybody woke up and said, if I can have solar power at 4.5 to 5 cents a kilowatt hour, I'll take some. Recognizing that it's a flat power price for the 25-year life of the asset. It doesn't entail any commodity price risk, and you don't carry any risk of future environmental regulation. So that demand elasticity that to me is indicia of the tipping point, as you want to speak it, the best place I can point to in the world is the southeastern United States. You can go elsewhere in the world and point to the exact same kind of dynamics taking place, this evidence that we've reached a fundamental change in the way the market is reacting to renewables. So in Dubai, the Dubai Electric and Water Authority, DEWA as they are known, they dabbled in solar back in 2013. They did a 13-megawatt pilot project, which we built. We actually built it at a loss. Because we wanted to get a toehold in the market and understand construction costs. They were very happy with the performance, very happy with the asset. So in 2014, they put out an RFP for a 100-megawatt facility. Included in that RFP was an option on the part of DEWA to double the size of the facility to 200 megawatts. There was very large participation. A large number of bidders participated in that RFP. And again, the pricing came in a little higher than the U.S., but still between 5 and 6 cents per kilowatt hour, which was a shocking number to the region. No one had any understanding that you could procure large-scale solar at those kinds of prices. The result was immediate and dramatic. DEWA themselves immediately exercised the option to upsize the plant to 200 megawatts. We lost the bid, by the way. It was won by Aqua, a large power developer in the Middle East, but it was won with our equipment. So, if I'm going to lose, that's the way I want to lose. DEWA had a 5-year solar procurement program of 1 gigawatt, that 200 plus another 800. They immediately accelerated the entire program, and they just recently put out an RFP in the last several weeks for 800 megawatts that they're going to procure immediately, solely as a result of the pricing that they saw in that bid. At the same time, we've now seen Bahrain, Jordan, Egypt, Oman, all immediately begin their own procurement programs of significant size and scale, and again, not based upon the Paris Accord or some mandate, simply based upon the fact that if they can procure solar at those types of prices, they'll take some. And I can point to India, where now the prevailing prices of solar in India are lower than coal. Coal in India is an imported commodity. It cannot be domestically produced. So in that market, we're seeing a point where people are procuring the power solely on the basis of the economic proposition. So what's always amazed me about renewables and the energy industry is a huge component of our economy. It's tracked and followed very closely. Every statistic is, you have the IEA, you have numerous agencies. But something I didn't ever really focus on until I moved into the renewable space full time is that all of the data in this industry lags by at least 18 months. By the time the government produces a report, publishes that report, and it's publicly available, the newest information in that report is at a minimum 12 months old and usually closer to 18 months old. Well, the challenge we have as an industry is, as Markus can tell you, 18 months in our industry is a lifetime. And any data or pricing information that you have that's 18 months old is no longer relevant. It informs you of nothing about what's possibly going on because of the rate of change. So one of the things that's beginning to happen is market reaction is beginning to catch up with data. So now we're starting to have some of these really low power prices are starting to roll into that official data, and you have policymakers and others that are beginning to scratch their heads and go, really? I go to cocktail parties and I conduct kind of this test. I'll say, well, what do you think solar power costs? And I'll get generally 10, 11, 12 cents kilowatt hour answers. And I'll get, it's 4 to 5 cents kilowatt hour, and we'll probably be under 4 within the next 3 years. And the universal, even from longtime energy participants that should know better, the universal response is shock. So that shock is going to continue to roll through the marketplace. And so, anybody who's heard me speak, you'll never hear me talk about climate change. You'll never hear me talk about the Clean Power Plan. You'll never hear me talk about any other program because, frankly, I don't think any of it matters. We're going to win this war, and we're going to change the world on the basis of economics. That was always the case. It always will be the case. Money trumps policy every single time. And the reason I came to the solar industry is if we wanted to change the world, we had to do it at scale. And we had to do it without the benefit of significant subsidy, and we had to do it with operating characteristics that allowed it to become a dominant player on the grid. So the extent to which we have accomplished that in a short period of time is astonishing, and I'll go back to those statements, those quotes. I go back to Jim Robos, which in many respects may be the most astonishing. One of the largest utility executives in the country. They have one gas plant under construction today. They've told me it's probably the last gas plant they ever built. Think about that in the context of where we were 5 years ago. 5 years ago, the expectation was that we would have renewable penetration, but that it was going to require massive adoption of new natural gas capacity to support bringing that renewable onto the grid. Very quickly, utility executives are coming to the conclusion that that's not how the scenario plays out at all. The economics of storage plus both PV and wind are coming down so fast, the same rate of change that we've seen on renewables alone, that the most cost-effective way to peak the system is very quickly going to be renewables plus storage. And that's what you're going to see. So then what happens to the grid? What does our fuel mix look like? What do utilities do? My own personal belief is you're going to see coal fall out of the bottom as they're either regulated out of existence or they reach the end of their useful life and are retired. Natural gas is going to expand and become increasingly a baseload fuel. That's something we didn't talk about 4 or 5 years ago. Natural gas wasn't $1.80 $1.85, $1.90, whatever it is today, 4 or 5 years ago. And most market observers, T. Boone Pickens the other day, now admittedly Boone is 89 years old, but he made the statement on CNBC that he doesn't think he'll see $3 natural gas again in his life. And there's lots of other participants that believe that the cost structure of the industry is such that we're going to see very low natural gas prices for a very extended period of time. So what that's allowed the utility industry to do is rethink the thermal stack and rethink how we build the grid of the future. And increasingly, you have a lot of industry participants that believe that as renewable plus storage comes onto the grid, that will allow utilities to take intermediate load plants today, drop them down in the stack. That's free capacity. It's an element of bringing storage onto the grid that people haven't thought about, that as you bring renewables plus storage onto the grid, you can take intermediate load plants and increase their capacity factor. That's free capacity, and at the current price of natural gas, it's very, very low cost base load power. And that we, as a result, in 2015, another statistic that if you step back and think about where we were is shocking, is the majority of capacity additions in North America in 2015 were renewable. There was more renewable capacity added to the North American power grid in 2015 than there was thermal capacity added to the grid. So again, fundamental changes have taken place and are taking place in what our grid looks like and how the grid of the future looks like. So what does it mean for our economy? What does it mean for our utilities? In my view, it's good news on all fronts. I think almost every major utility in the country now views renewables as an opportunity, not a threat. They accept that it's a fundamental part of the grid of the future. They accept that they need to learn how to adopt it to make sure that they maintain reliability, but I think there's a growing belief and comfort that we can have significant adoption without threatening the grid. They increasingly recognize and believe that it can be done cost effectively without driving our power prices through the roof at the consumer or the industrial level. It means that our industries, and I know that's important to this region, will have low-cost electric power to support their manufacturing processes, which is important for global competitiveness. The natural gas industry, if you were to go back 5 years and discuss a major renewable adoption program, most people thought you would see massive investment in new natural gas capacity alongside that renewable adoption. I think that's beginning to fade. There are still some people that believe that, but increasingly I think people believe there'll be modest investment in new natural gas capacity. It's not bad news for the natural gas industry. There's two things going on that are very healthy for the U.S. economy and very good for the natural gas industry. One, export of U.S. natural gas as LNG is going to commence shortly. I think Cheniere will load their first cargo in the next several weeks and be the first U.S. natural gas shipped offshore as LNG. Export is always good for any economy. It will be good for our economy. And then two, and maybe more fundamental and more importantly, there's something going on that a lot of people haven't really focused on, and that is the U.S. petrochemical industry is rapidly shifting from crude oil as a feedstock to natural gas as a feedstock. And you have massive investment in either the conversion of existing petrochemical facilities to a natural gas feedstock or the construction of new facilities that will create feedstocks for the chemical industry. There's also new catalytic technologies coming into place that will expand the feedstocks that you can create with natural gas. The investment is huge. So I live part-time in Houston, part-time in Phoenix, Arizona. You would have thought that the Houston, Texas economy would be crushed currently with crude oil at $30 and natural gas less than $2. The reality is Houston's doing quite well. And the reason is that while, yes, there's certainly stress in the oil field services and the natural gas business, the petrochemical business is booming. And the U.S. petrochemical business is booming. And that's in large part because they have the advantage of clean, low-cost feedstocks from natural gas, at the base front end of the industry. There's some $45 billion of new chemical plant capacity being constructed on the Texas Gulf Coast, all related to natural gas feedstocks. So if you look at the economy of the future for the United States, you have an electric grid that's going to adopt low-cost renewable power. We're going to have substantially greener grid. We're going to have a very low cost and a very effective grid. We're going to have healthy utilities as a result of the opportunity to invest in the grid of the future, so to speak. We're going to have healthy industries because we have low cost power and energy available for those industries. And we're going to have a robust energy industry, certainly on the natural gas side, because we have this tremendous global advantage in terms of low-cost natural gas that we can export as LNG, and we can use as the front end for a petrochemical industry that is increasingly competitive on a global scale. One of the challenges that China faces today in competing with the U.S., one of the places we have a fundamental advantage is in this natural gas-based petrochemical industry. The Chinese petrochemical industry is all coal-based. It's not crude oil-based, it's coal-based. And the economics of that petrochemical industry are rapidly falling behind what can be achieved with low-cost natural gas. So oftentimes in the press and in the media and in our elections and in our politics, you get this, that the world of energy and the world of electricity is all the old fossil fuels versus the new renewable power. I think it's, to be honest, that's complete and total garbage. There is an economy and a country and a power grid and a world that can be built that is healthy, lots of jobs, very competitive for all aspects of the U.S. energy industry. I am more optimistic today about the U.S. energy industry broadly, and by that I mean oil, natural gas, and power, renewable and conventional power, than I have been at any point. I'm also enthusiastic about First Solar as a company. I'll give you the 5-minute sales pitch. Markus had very nice remarks. A little bit about the history of the company. I always find it interesting. A lot of people don't know how First Solar came to be. So First Solar was founded by a venture capital firm called True North Venture Partners. The visionaries behind True North Venture Partners were Mike Ahern, who's currently our chairman of the board, and a lot of people don't know John Walton, member of the Walton family. And so the Waltons provided most of the money that was the original fundamental research that created CAD-TEL thin film photovoltaic panels. They remain our largest shareholder and one of our largest supporters today. They own just under 1/3 of the company, and I expect they will continue to own it. They view it as a family legacy. I came on board in early 2012. Anybody who's followed the solar industry will know that 2011, 2012 was a very rough period. There was significant excess capacity and falling demand in Europe. Most of the companies went through a very difficult time period. First Solar had the benefit of a lucrative project development business that helped carry us through that period. We also made the decision to place an incredibly heavy bet on research and development, fundamental research and development. We committed to fundamentally changing our product to increase its competitiveness in the marketplace. We spend significantly more than $100 million a year on research and development. That's more than the rest of the industry combined. We have, if you go back to 2012, when I came on board with the company, we were producing panels with a conversion efficiency of less than 12% at that point. Today, our lead lines are producing panels of a conversion efficiency of greater than 16%. As Markus mentioned, we have cells well north of 20% research cells, and we have research panels of 18.3%, and we have a long track record of converting our research products into full-scale production products, and we will do that over the next several years. So we will, and we have no plans to slow down. We have a technology vision that extends to 2020 and beyond. We intend to fundamentally change the marketplace. So we talk about 4 to 5 cent power in the United States and 5, 6, 7 cent power in a lot of the rest of the world. We fully expect in 2020 timeframe to be talking about 3 to 4 cent power and maybe lower. We also fundamentally believe that storage, the cost of storage is coming down. We've spent a lot of time trying to understand how you integrate storage with a utility PV product. We believe there's a lot of synergy that we frankly didn't recognize at first, and that on a blended basis, in a very few years, we'll be talking about 5, 6, 7 cent power that's fully dispatchable, PV power that's fully dispatchable. Not 24 hours a day, but that's not needed. Over the time of day that's needed, which is basically the peak demand hours. The big weakness of utility scale solar today is we fall off a few hours ahead of when peak demand falls off for the utility. It's about a 3-hour, 2 to 3 hour period in most utility systems. So to really become, for all practical purposes, a dispatchable asset for the utility, we don't need 24/7. Anybody who talks about 24/7 solar power doesn't understand the utility grid. Power is plentiful and free in the middle of the night. There's absolutely no reason to try to take solar power and deliver it to consumers at the middle of the night. What we do need to do is we do need how to figure out how to spread our production over a couple of additional hours at the end of the day. That can be done and will be done very cost effectively so that within a very few years you won't hear discussions of the problems of the reliability. Those problems are going to rapidly be mitigated with cost-effective storage. So with that, they've asked me to allow a few minutes for questions and answers, and so I'll be happy to take those. I don't know, do we have a microphone? No, that's just.
What battery technologies do you think going forward will be the most prominent to deliver?
I think our view is near term, it's going to be lithium ion. We don't see anything near term that beats it. Medium to long term, there's a whole bunch of alternative chemistries as well as flow batteries that look promising. I don't think we are of an opinion as to which of those are going to scale and compete most effectively. They all, just as with PV technologies, every technology has its sweet spot. And I think what you'll find is technologies will develop that are unique to a particular application. It's not going to be one winning technology. Storage, you're going to have storage that sits alongside renewables in the field, harvests excess DC, or utilizes the synergies of a single interconnect. You're going to have storage that's smaller scale, lower voltage, that sits at the distribution level and helps to manage the system. That's what peaking of the future looks like, in our opinion, is you're going to see that'll largely be lithium ion installed at the distribution level to help the utilities manage the volatile power flows that they are starting to see at the distribution level. And that looks to be pretty cost effective pretty soon. You'll see other storage that helps industrial users clip their peak demand. Those customers all pay demand charges. And they can clip their peak demand with a little bit of storage, and there's a variety of technologies that may do that. So I think our view is it's not a single winning technology, it's a variety of technologies and some chemicals. But I mean, for us, the game change in terms of how we thought about it was, as lithium ion comes up to scale, we think the economics of that work. So we're not waiting on some technological breakthrough. We think that's already happened. It's just the economies of scale will drive costs down in the reasonably near future.
Thank you.
Yes, sir.
There's been some recent research that shows that the intermittency of wind and solar dramatically drops as you expand the spatial scale of generation. And the work showed that with some augmentation to the grid, you could actually use that to produce reliable, almost base load, or reduce the reliance on base load. What's the scale of the grid? What's the scale of the production and delivery at this point? And does that seem like a viable way of really addressing the intermittency problem?
Well, there's two things that happen as you increase the scale of penetration. And it's different for wind and solar. So I'll leave wind to the wind guys. But wind is a variable resource, and the variability is a little bit less predictable than with solar. But simply as a statistical matter, the more installations and the more geographically diverse are those installations, the less the intermittency becomes an issue because you tend to have an average across the system. For solar, you can engineer the system geographically. And by that, the siting of solar versus load impacts when that power is delivered relative to peak demand. The place where we have the biggest challenge in the U.S. is, frankly, California. And the reason we have the biggest challenge in California is California, for a variety of reasons, has a very late in the day peak. They don't have air conditioning load, particularly along the coastal areas, because it's a moderate climate. They've got the cold waters of the Pacific Ocean. So you don't have an air conditioning load in the mid-afternoon the way you would in, let's say, Arizona, where I am, or in Texas. But the bigger issue is all of the solar resource in California is east of load, and you can't put anything west of load because otherwise it would be in the ocean. So the time shift of load versus production is opposite of what you want. The complete opposite of that is the ERCOT system in Texas. So in the ERCOT system, almost all of the load is in the eastern third of the state, being Houston, Dallas, and the Austin, San Antonio area, and all of the good solar resources in the western third of the state, essentially the Permian Basin and west. You have almost a full hour of sun time difference between the load and the production. That shift has a dramatic effect on the match between production and demand. And so this issue of extending to cover the evening peak hours is dramatically reduced in that system simply because you have what I call geographic storage, the ability. So, but in any system, if you think about the United States, you can solve a lot of these problems with transmission simply by siting. You move the power back to the direction where it can serve the load. So you move solar power from west to east consistently across the country with transmission. There's cost to that, but then it's a cost of what's cheaper, that transmission or storage. The problem is you run out of the ability to do that in California. So the first and the biggest storage market will clearly be the California market because it's where you have the biggest problem. But there was this notion that increased penetration of renewables into the grid exacerbated the intermittency problem when you're actually correct, it doesn't. Now, there are big issues that will have to, California is reaching a point where they have so much renewable coming on that at certain times of the year, their renewable load is going to back almost all of the thermal out of the system, and that candidly is a problem. You can't back all of the base load off, and you do have to have some spinning reserve that remains on the system. But it's a manageable issue sophisticated procurement and sophisticated grid planning can deal with. Yes, ma'am.
Where do you see nuclear energy fitting into the energy mix, and do you consider that a renewable source?
I consider nuclear energy a low-carbon source. I don't know whether renewable is the right defined term. I don't have a strong opinion, quite frankly. The one area of the power system I've never participated in is nuclear energy. I've never been responsible for a nuclear plant. I've never had a nuclear plant within any of the utilities that I've run or any of the generation companies that I've run. So I don't have a strong position. Personally, this is not for solar policy or anything else, I think that some of the newer, safer nuclear technologies have a lot of merit and should certainly be part of the system. But we as a company don't have a big position on that. We don't have an opposition, and we're not a big advocate. It's not our expertise, and I'll leave that to people that are bigger experts than me. Yes, sir.
So what are your thoughts on solar 24/7 with storage? In countries where you do have a presence now, in Asia, where the grid is weak, it could play a very important role.
Yeah, so most of my comments on the grid relates solely to North America. The grids in many parts of the world are fundamentally different, and the economics are fundamentally different. So you could go to any one of a number of countries, and the analysis and the solutions are going to be different. If you take India as an example, where we have a very large presence, India has a severe need for additional power on the system, to the point that it really doesn't matter whether it's intermittent or not. They just need to get more power on the system. They manage their grid not in the way Western utilities manage their grid. They manage through shedding load. They don't have a choice. They have more load than they have power, so they manage the grid through shedding load. Anytime you're in a circumstance where that's the way the grid's managed, one, it's harder to keep the grid stable when you're shedding load. It's much easier to turn a gas plant up and down, or curtail a solar plant, or curtail a wind plant than it is to manage the system through shedding load. So they simply need more power, more hours of the day, almost all the time. So that changes the angle a little bit. There's less concern about grid integration. It's more just, let's just get the power on the system. The other is the economics, particularly for businesses of self-generation, are fundamentally different when your grid's not reliable. So that's not a calculation that you make in the US. Businesses don't suffer production outages as a result of the power system, except in very, very rare circumstances in the US. In India, backup power is critical to 24/7 manufacturing operations because they do suffer outages. And so when you look at storage, PV plus storage there on a 24/7 basis, the economics are different because today they're providing that reliability largely with distillate-operated reciprocating engines. The cost of that, even at today's oil prices, PV plus storage can easily undercut. So in different parts of the world, the economics are different, the solutions are different, the grid looks different. I mean, one of the things that you learn when you participate in power on a global basis is every region is different, and the answers in every region are different. You can't analogize what works in North America to what's going to work in the Indian subcontinent, to what's going to work in Australia, to what's going to work in Chile or Latin America. Yes, sir.
Yeah, could you give us your thoughts on that outlook going forward for the economics and adoption potential of distributed rooftop solar versus utility scale solar?
Now you're going to get me in trouble. It's well known that I'm not a huge advocate of residential rooftop solar. I have a different view on commercial and industrial. My view is really simply based upon the economics. So today, Markus can go build utility scale solar at $1.50, $1.75 a watt and have between 25 and 30% capacity factor in a location with reasonable irradiance. The numbers that seem to be coming in is that we're still somewhere between $2.75 and $3 a watt in the residential sector in the U.S. with capacity factors under 20%. Those numbers don't work. And I made the comment the other day, which is what I continue to believe, net electric metering at the retail level fundamentally doesn't work. And you're seeing that begin to break down across the country. So for the rooftop business on the residential side, commercial and industrial, it makes a lot of sense in a lot of places, a lot of circumstances. It's not a business we're in, but I think it's going to be a big and robust business going forward. New construction where you can design and integrate the system into the local electric grid and into the home probably also makes a lot of sense, and I think we'll see that in new residential construction, particularly large tract home subdivision type of constructions. The residential retrofit costs have to come to a point where it makes economic sense without the benefit of retail net electric metering, because I simply don't think that it's that's a sustainable rate structure or business structure going forward, and I think achieving those economics is very challenging. When you have the utility scale guys saying, in a couple of years, I'm going to be delivering you 3.5 cent power all the time from utility scale, the notion that you can make the numbers work on the rooftop. Now, there are niches, there are locations, there are places where it makes sense. Storage doesn't fundamentally change the equation, in my opinion, and the reason is simple. The only way you change the equation is if you can remove the dependence of the home from the grid. Otherwise, the home has to pay for the grid. I mean, that's just a fundamental truism. If you're going to rely upon the grid, you got to pay for your fair share of the grid. And that doesn't change if you're using 80% solar electricity. The meter's the same cost. The cable to connect your house to the grid is the same cost. The lineman that's going to maintain those assets is the same cost. The emergency response capability that the utility is going to maintain to respond in circumstances of weather or otherwise is the same cost. So you don't have an offset, and furthermore, you can't harvest enough electricity off of a residential rooftop. Let's see, even if storage was free, you cannot harvest enough electricity off of a residential rooftop to support the 24/7 needs of the home. There's just not enough square footage. Even with the most efficient panels available today, you can't harvest enough gross electricity to serve the needs of the home. So my own personal skepticism, I just don't think that the numbers work. That's been my public position for a very long time. It won't be new or shocking to anybody. There's some very good companies out there. I believe if utilities are not offering their consumers choice in terms of the source of power, that's the most powerful argument that the rooftop industry has, and is a very legitimate argument. People should have the ability to express a preference for how their power is produced. And I've said publicly, and I will continue to say publicly, that I think all utilities need to offer their customers a green power alternative. And if they're not doing that, then they're enabling what I think is the very strongest argument for residential rooftop, which is consumers should have the ability to express a preference as to the source of their power. So none of that's a new position on my part. No one at any of the rooftop companies will be surprised to hear me say that, but that's just my own personal view.
Jim, I'm here.
Yes, sir. Go ahead.
So I'm going to be the first one to use the microphone, which is supposed to be doing here. If I may add, great presentation. What a way to start the second day or the final day of the summit. I actually came here to ask one particular question, but then you started answering another different one, so I have a follow-on question for that. So the first one is, you talked about cost, you talked about performance. Both are, so cost decreasing, performance improving. What is the reliability factor? Can you explain that, and how much of your operating budget are you allocating for O&M, and what kind of technologies, inverters and others, that would improve your reliability factor? So that's one question. The second one, along the lines of residential and commercial systems, you talked about, and you're absolutely right, grid integration costs of residential is far higher. So what are the numbers for commercial scale and utility scale solar for integrating into the grid, and what the utilities are penalizing you for doing that?
So let me start first with reliability. So reliability is the single most important factor that we view as a company. Any one of these utility scale solar installations has literally millions of panels in it. They're all made in one of two major production centers. They're all made exactly the same way. If there's a fault in one, there's likely a fault in all of them. So we live, breathe, and die reliability as a core of the company. We test extensively. We go back and visit our customers' facilities on a regular basis to check the performance, to make sure any little idiosyncrasy or variance, we dig into it until we understand the root cause and make sure that we don't have some sort of issue. At the O&M level, we offer comprehensive O&M services to our customers. Some of our customers take advantage of that, some don't. When we offer that comprehensive service, that essentially includes a long-term guarantee of the power output of the facility, which includes the inverters and all of the AC infrastructure as well as the DC infrastructure. The good news is there's not a lot of moving parts in a solar facility. Assuming the panels are functioning, you will have an overhaul cycle on the inverters, and you will have some routine maintenance on the DC infrastructure. But it's, you know, as long as the panels continue to perform along the vectors that, you know, were originally promised, it's, you know, reliability in terms of separate from intermittence, the reliability of the facility itself, we run much higher reliability numbers than any thermal plant I've ever operated. So, you know, you're talking high 90% type of reliability numbers for the plants.
One more question.
Then on the other, the charges that the utilities associate with grid integration are not explicit today. They're really buried inside their own cost of service, and so you can't really identify. They're modeling it in their own rate cases, but it's not something that you can explicitly call out and identify today. So it's difficult to answer that question. All right, one more. Very back. Yep.
Do you see any changes in ownership or financing trends with all of the costs?
If I knew the answer to that question, I'd be a billionaire. We've seen huge volatility in the capital markets. We've seen huge volatility in the ownership vehicles. It hasn't changed the underlying cost of capital much. You know, you've seen yield co's come and fade, but there's been large institutional owners of these assets who are still there, that still have very, very strong demand for the assets. So while there's a lot of noise in the marketplace in terms of public vehicles, companies getting into financial difficulty, for us, in terms of the market for the assets that we create in our development business, there have been little undulations, but there hasn't been a lot of volatility. I think the big question mark is going to be, as we move from an accommodative Fed stance to a tightening stance, and we see what happens to the yield curve over time, what happens to the yield vehicles. And this is true of the entire energy spectrum, because while the renewable yield companies have been savaged, so have the MLPs, which are largely applicable to the conventional energy sector. And so that whole sector's taken a huge hit. My view is we're going to have to get a little further into the current Fed cycle, see what happens in the capital markets, and then we'll be able to draw conclusions. I simply think it's too early. And so, you know, we're in sort of a watch and wait mode on how the capital markets are going to settle out. Thank you all for your time. Appreciate it.
We are taking a break now. Jim will still be outside having a coffee, so for those of you who still have questions, I'm sure he's going to be available for a few more minutes. Thank you very much.